Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today is the governor of the great state of real estate in Texas, Mr. Michael Becker. Michael, how are you?
All good. Just barely made this podcast. I was on a due diligence assignment and wrapped up early, so I'm glad to be here.
Very difficult to keep in tabs on you. You are always out there doing these incredible due diligence assignments and always doing great work with God's work for SPI. So good for you. Joining us, of course, the professor, Mr. James Zhang. James, how are you?
Good. Thanks for having me, Paul.
What is going on in the Old Capital world these days, James?
We just wrapped up our bus tour. So we went and saw 5 or 6 properties with 40, 50 investors, looking at deals that we had financed and then also looked at deals that were coming on the market. So thought that went pretty well. Upcoming events, we definitely have our big conference. So go to oldcapitalpodcast.com and you can see the list of events, whether it's speaker series or upcoming bus trips or conferences, things like that. Go to oldcapitalpodcast.com and you can see the latest.
Follow me on this analogy a little bit. You ever see concentric circles of a spider web, James?
Like Charlotte's Web?
Charlotte's Web. And in the center of the web was Charlotte. And everything was coming in to the center. Well, that's kind of how I feel about this guy that we're going to have on the podcast today, a friend of the podcast. We've known this gentleman for a long period of time. He has some great insight about what's going on in the apartment industry. He's the chief economist for a group here in Texas that I think you want to get to know and spend some time with. But he is an expert of apartments, and he tells us a little bit about what's going on. He's the guy that is in the center of the spider web. Mr. Greg Willett, Chief Economist for Leaselock. Greg, welcome to the podcast.
Happy to join you guys today. And if everybody else gets a special title, can I be like mayor of Dataville or something?
Well, that is where really you are the mayor of the spider web of data that comes in, and you're the guy right in the center. So Greg has some great information about what's going on. So I'm going to turn it over to Michael and to James, and let's start to talk a little bit about data in the apartment industry these days.
Yeah, Greg, Michael? Last time we had you on, you were somewhere else. So what's new? Yeah, Leaselock, maybe start there, kind of tell everyone a brief background on yourself, and then kind of what is Leaselock, your new company?
Michael, so yes, I am new to Leaselock, which is a prop tech company that makes housing more accessible for renters, replacing a deposit replacement product there, and then really looking at risk mitigation overall. So protecting NOI for investors and operators. As you mentioned, I'm new to this company. I was with a head of research, multifamily research for a brokerage firm before that. And then a long time I was in that prop tech space and a lot of different technology products that we had in my previous capacity. So I'm back sort of in real estate world and sort of in tech world.
Well, welcome back to the tech world, I guess. So yeah, what's kind of, generally speaking, love to kind of just get your view of the world, maybe kind of broken down and from kind of the multifamily fundamental standpoint versus kind of what are you seeing from like, capital formation, investment sales standpoint. And then we can maybe drill down into some of the markets and kind of see where it goes. But kind of what's the 50,000 foot view from your world right now?
I'll start with just the big picture on the economy. And coming into the year, I was pretty confident in the overall performance of the economy. With every set of data that comes out right now, you're starting to see a little bit more vulnerability emerge in what's going on. That means that while I certainly still think that renter demand for apartments this year is going to be pretty healthy, I maybe am backing off a little bit from the robust forecast I had at the beginning of the year. And my concern is really in focused on consumer confidence, and that's fading a little bit. And certainly that, if you listen to earnings calls from retailers, they express a little bit of concern as well. Another data point that I'm looking at pretty closely is credit card debt, which is running up pretty quickly, and delinquencies are beginning to show up and creep upward as well. So I think maybe that means demand for apartments this year solid, but maybe not the robust number that we thought it was going to be a few months ago. I will point out we are at the very start of prime leasing season, so we'll see how that comes together.
Yeah, I mean, I'm kind of feeling, it's a small subset that we see, but it seems like the first month or so kind of leasing season's been normal, like a pre-COVID normal, where you're seeing demand kind of tick up and seeing kind of generally occupancy increase, and kind of expected that we were going to see some rent growth, or less bad in Austin, let's say, but rent growth in Dallas. And we're focused predominantly in kind of your class A minus space. So we're kind of feeling a little less competition on the margins from new deliveries like we have for the last few years. That's kind of 4 weeks into this as we talk today. So, it's not a ton of data. I want to see that follow through, but kind of the early signs have been pretty positive from my perspective. Are you seeing or expecting some divergence in kind of the workforce housing versus kind of your class A when you're talking about performance? Is that kind of a tale of two cities?
I think that what we're going to see is a little bit of a struggle to get those brand new Class A deliveries through lease up. But at the same time, the performance looks pretty solid for that middle tier to bottom end product. And it's kind of two sides of the same coin here, that if you struggle a little bit on household formation and don't get the overall net demand at the number you would like it to be, that means when consumers are concerned about the outlook, they tend to just freeze up and stay in place. So I think for stabilized properties, when you have expiring leases, you're going to hang on to those residents probably at record levels during the course of this year. And you're still getting some rent growth on those renewal leases. So bottom line, a big contribution from the renewal standpoint, and then maybe a little bit of a continued sluggish performance on move-in sort of leases. And
Yeah, I'd probably say that's fair. What I'm seeing is you're seeing marginally positive rent growth on renewals and marginally negative on new lease trade outs, and you're kind of neutral, I guess, overall when you kind of blend it together, or maybe slightly positive as we renew at a higher percentage. And do you foresee the back end of the year being better than the front end of the year, or do you think the uncertainty of the economy might take a little bit of wind out of the sails as we get later in the 2025?
we're still very much uncertain as to what's going to happen with the economy. And so let's see to what degree we're actually going to have tariffs impacting everything. And that's going to be different across sectors, and it's going to economic sectors. It's going to be different across regions. So let's see how that comes together. And then we have to watch those immigration numbers too. There are a lot of markets where recent immigrants play a pretty big role in the housing market.
And I don't want it to sound too much. So how does Leaselock sort of help landlords, in this environment? Because obviously there's a lot of uncertainty. I think that's the number one word that the Fed chair used at his last speech is uncertainty. So, how does it help? Maybe let's just talk about owners right now for Leaselock.
Well, again, the core product is a replacement for deposits. So that helps the segment of the renters who have some affordability challenges. So it's easier to get some residents qualified and into the units. And at the same time, we've got processes in place to be sure that the screening, resident background screening is done properly, et cetera, so that you're not taking on additional bad debt risk at the same time that you're getting more renters into the property.
Okay, so instead of them putting up a Do they just pay like a risk fee or something?
They're paying a small monthly fee rather than a big upfront security
Instead
deposit.
of like a full month. Okay, I got it. All right. And then I guess in terms of, workforce versus Class A, I mean, I think we're seeing some on the Class B and C side, we're seeing deals have to struggle. They're not necessarily, let's say Carrollton, for example, they're not necessarily struggling with new Class A in that pocket, but then they're struggling with properties that are going maybe 60, 70% occupied and they're having to give concessions. And so I've just seen a lot more concessions in the B and C space than we've seen in like the last 10 years. So I don't know if you're seeing the same thing, or when do the concessions for B and C stop, in your opinion? Because they're having to give away, on that Class A side, if you're in lease up mode, you're giving away a month to 2 months, depending on what submarket you're in. But then like these Class B and C deals, they're having to give 500 to 1,000 to 1,500 to get people in the door right now.
But certainly some rent giveaways have crept into the overall system at this point. And again, I think the headline story for this calendar year is going to be resident retention and heads on bed. So you're doing what you need to do to try and hold on to your existing base. And to some degree, those are price adjustments. But I'll point out DFW overall, I mean, rents are basically flat at this point. There are certainly some pockets of rent giveaways that are showing up, but it's not, I wouldn't characterize it as the norm to have these really sizable discounts in most neighborhoods.
Have you seen anything interesting that ownership has done on resident retention to keep it? I've seen people fight and literally until the last day, so that the tenant gives them notice, hey, I'm moving out, and that's 60 days in advance, and then the landlord keeps cutting from 1,500 to 1,350 to 1,300 until they finally sign it. So have you seen anything on the resident retention side?
Well, the retention numbers are still looking really solid. And in fact, in most markets, they're up year over year. And that includes here in Dallas, Fort Worth. So, but you're correct that what you see is if a new lease is going to get executed, it tends to drag out that process and it doesn't happen until you're up at the deadline versus when the renewal notice goes out, they don't immediately sign for it.
Yeah, we're talking more DFW, but what are you seeing, let's say maybe down in Houston, and then maybe let's touch on Austin and San Antonio.
Certainly, if you look at Texas markets right now, Houston is the strongest performer in the state, partly because it has not had the wave of new supply that you've seen in North Texas and in Central Texas. And at the same time, you've had some pretty solid employment growth in that market, maybe even a little bit stronger than what you've seen elsewhere. So Houston is in relatively good shape. A little bit more of a struggle in DFW, although, it's certainly not at the premium performance that we've seen historically. And then the parts that are struggling are certainly San Antonio and Austin in particular. And Austin has just had this wave of construction that's not been seen anywhere else across the country in terms of the percentage rate of inventory growth. But that is coming down in Austin, and Austin will get better, but challenging right now. And then I'll also point out that traditionally the strength of Austin's economy is the tech sector, and we're not adding tech jobs across the country at this point, except in very specialized fields, particularly artificial intelligence. You're adding some jobs, but that's mainly in the West Coast markets and not so much here in Texas.
So San Antonio is still getting hit with supply, or
to some degree it's being hit in supply, and then some of the challenges that you've seen in Austin just tend to spill over into San Antonio. We had several years where San Antonio was really drafting off the success that you were seeing in Austin. Now, Austin is actually holding back San Antonio a little bit.
Yeah. So speaking of supply, I saw a chart that kind of showed a material decline from kind of the prior peak of new starts by quarter to kind of the fourth quarter, which is the most recent complete quarter as we talked today, and seeing, somewhere between 70, call it 75% on average between Dallas, Fort Worth, Austin, Houston, lower starts to the fourth quarter than the peak start at some point in either Q2 or Q3 of 2022. And I think San Antonio went down about 92 or 93% from the peak to last quarter. I think there was 300 units. So like one deal started in the fourth quarter of 2024 in the San Antonio market with 220,000 or more multifamily market rate units. When do you see that like positive impact from ownership perspective? When does that start bleeding in? When do we see the rent growth and the backside of all this stuff?
Yeah, Michael, certainly the starts numbers are way down. And really, in all these markets, the difference between the start number and the completion number has never been bigger than it is right now. So that means that we are going to be winding down all these deliveries. But particularly for Austin and DFW, the delivery numbers are still pretty big throughout this calendar year, not quite at the levels we saw last year, which was the peak, but still above normal. So for those markets, I don't think we really get momentum in overall performance that's tied to those supply numbers. That doesn't show up until 2026, but it's on the way, but slower to arrive than in Houston, which I think you're already starting to see some pickup in the momentum. And then I think San Antonio will wrap up a little bit more quickly than Austin and DFW will.
And so my perception, and maybe I'm off, is that most of these deliveries that we're going to see for calendar year 2025 are more front loaded than back loaded, and I don't know if that's accurate or not, but that's kind of my perception of it. Is that fair?
I agree that the scheduled deliveries are front loaded, but when is it actually going to get across the finish line and really be done? I think that we're still going to have significant product delivering in the last half of the year too.
Got it. And then, so I just came from a breakfast this morning that had a bunch of developers in the room. It's a ULI breakfast here locally, and they were kind of the economist, one of your competitors, I guess, was kind of forecasting nationwide rent growth of 26 and 27, kind of in that mid 4 to 5% range, maybe. Is that seem fair when we kind of get on the
4%
back
rent
side of
growth?
4 to 5% rent growth?
Wow.
And 26 and 27, kind of flat-ish, maybe nationally a little bit positive, but certainly market dependent, where Detroit's leading the nation or something like that for the first time in probably 70 years in rent growth for 2025. Is that kind of the historical average is 3%? Do you anticipate seeing above historical average as we get into 26 and 27 for rent growth?
Yeah, I'm going to agree with that. I mean, if you think of normal is, let's say, 3.5-ish, that 4 to 5 certainly makes sense as we get to 26, 27. I've seen some forecasts that, you surge up into close to double digits, and that's not going to happen. But I do think that we do get above the historical norm over the next couple of years.
Are you seeing anything from your view of the world for investment sales? It seems like we've seen a real slow start to the year. At MHC, there was, next to no inventory out, at least in the markets we would play in. And then kind of March, we've seen kind of a surge of listings from late February into March. And it seems like it's kind of all over the spectrum of new development and workforce housing, both kind of surging. And those deals are all kind of pricing out right around now. So I'm curious to see where values actually get priced. But what are you kind of observing from the activity and then the amount of capital that's seeking the various product types?
Yeah, I would certainly agree with what you've just said there, Michael, that we got off to a slow start on transactions as we came into this year, but it's probably going to pick up. And, we talked about, we do think that fundamentals get meaningfully better in 2026 and 2027. So if you're going to take advantage of that upswing, you want to get those deals done in the last half of this year so that you're well positioned for what comes ahead. And then, I'll throw in there that of late we've seen maybe a little bit of stabilization in 10-year treasuries. That's what really hurt. The increase in interest rates on and 10-year treasury numbers at the beginning of the year is what stalled out what looked like with some transaction momentum that was showing up late last year. The numbers are still not ideal, but we're headed toward a situation where the first number in that 10-year treasury yield will be high threes to low fours versus there was a point there where it looked like we were moving toward five.
Yeah.
Can we talk a little bit about, transactionals? James had a piece today I thought was great in LinkedIn, talking a little bit about transactions coming onto the market, opportunities to buy apartments. I think you said 9 deals came to the market, James, in 7 hours yesterday.
Yeah, I can't keep track. I had to delete that was just Dallas Fort Worth. I had to take out Austin and San Antonio and Houston and all the deals coming out. But, when you reach out to the broker and say, hey, what's the whisper price on this deal? You're getting a mixed bag right now, I think. Some guys are like, well, the newest word I've heard is dual track. Dual track. All right, well, I'm going to list it. I'm going to talk to my existing bridge lender, and I'm also going to try to refinance this deal. So I'm going to take it down these 3 railways, and hopefully in 3 months, I'm going to do something. So we don't know if I get a good price, I'll go right now. If 10-year treasury drops into the threes, I'll refinance the Fannie Freddie. But if it doesn't work, then I'll just do the extension on the bridge loan. And I probably need a modification from the bridge lender to do that. So I don't know how many of those deals are going to sell. I mean, I think the A stuff is selling right now, just based on what we've seen on recent tours and just the amount of activity that people are going after these deals. But yeah, I mean, we talked to some brokers earlier on the B and C stuff, and you thought you had 3 guys, and all of a sudden it becomes 2, and then there's 1, and then none. So on some of this stuff. So if you've got a good buyer, keep them on the hook.
Man, I just had a transaction last week, James, where the seller needed certainty of closing, and our buyer was higher than what another buyer was. Now, our buyer was a syndicator that needed to raise the money. They were very confident they could raise the money, and they were 50, 60, 70, $100,000 higher. And there's another group that actually won the deal, was maybe a 1 or 2 check writer group that had a little bit of a longer history than my group. So really, it's a certainty of close these days is I think a lot of the sellers are looking for. And just like what you're saying is that if there's a certainty of close with a buyer, a lot of these guys are willing to take a lower sales price. So that sales price is, and sometimes buyers said, is the most important thing to try to go as high as possible. But certainty of closing, I think, is probably the biggest thing for sellers these days. Michael, what else was discussed at your Urban Land Institute breakfast meeting this morning that you thought resonated?
A couple of the developers in the room just saying they're getting capitalized for this. So the capital's like kind of loosening up a little bit versus say same guy a month ago said it wasn't. And this is Dallas focused. So I'm sure it's still impossible in Austin to get capitalized to do a deal or San Antonio. But yeah, it seems like Dallas is starting to get some development capital kind of loosen up. I think the debt's been there for construction. It's just really been the equity's been kind of the problem. So it seems like that's maybe like loosening a little bit. So maybe we see some more starts than not. I don't know. The tariff thing seems like what Greg
the
kind of
cost
mentioned.
piece, right?
That's a big variable. So if those tariffs actually come through, probably delays until that's kind of settled. I think that probably delays some of the starts, I would imagine, with that uncertainty out there. If your cost goes up, 25% on lumber, it's a big miss on your construction budget. So it just seems like it's starting to be a little more optimistic in that room. Those same guys I was with about a month ago were all depressed. So it's kind of, maybe directionally getting a little better from a sentiment standpoint.
Yeah, and talking about development dollars, mortgage dollars, the ability that a bank, which would usually typically do the construction loan, or somebody that wanted to build apartment buildings, a friend of ours that this group knows very well, a qualified banker that lends big money on big apartment buildings. He's been shut down for 18 to 24 months, and now he just got the directive from his senior person that let's go out and make some loans, guys. Let's go out and make some loans.
Yeah. So it seems like the debts there are coming back quicker than the equity, but it seems like the equity's starting to thaw. I had a very large household name that we bought a couple deals from. That was the equity. Take me to lunch on Monday, and was asking me what we got because they just raised a $3.2 billion fund and they need to put the money out. So, they need to write checks, and bigger checks and smaller checks, and they want to put it, largely in housing. And so that was, kind of seems like the capital starting to thaw out. So, it seems like you got to clear all these deals that are on the market that can be had below replacement cost before you see large scale construction start up again, because otherwise you just buy it below replacement costs and not have to wait 2 to 3 years to build it and take all that risk. So you just buy it now. So I don't know. Greg, do you have any thoughts around that?
I'll point out that all four of us are in Dallas Fort Worth. And in terms of the money sources, the first place it comes back is probably this market. So it's not surprising to see a little bit of an upturn and, dipping your toes in the water of putting some more capital out there, with it showing up here before it does anywhere else.
The delta between the replacement costs and then market cost is the thing that I'm most concerned about. I had a conversation with a friend of ours today who went actually to take a look at a property that is on the market right now. And, he was just making comments, not so much on that property, but that he was talking to kind of the same group that Michael was talking about. Is market value is like 250, but it costs 240 to rebuild the property. So the delta is not great between what the market cost is and what the replacement cost is these days. So he's very, very concerned with that. Now, if it was 160, 170, a market cost, that would be something different. What's your take, Greg, right now in terms of equity, of people putting money into the market itself? What are you hearing from institutional people or even people that are writing $100,000 checks to put into syndication? What's your 2 cents on that?
Well, certainly the stack of capital that's been raised is enormous. And we are getting to the point that you're going to have to deploy some of that capital in the near term, or you got to give it back to where you sourced it from. So I think that's going to spur a little bit of activity. And then some of these funds, you had an end date as well on these funds, and we are reaching the end date on some of the money that was raised several years ago. So again, I think that's going to force some activity in terms of current owners putting some product out there as well. So I just think we're in a situation where, from both sides of the equation, we're pushing toward transactions have to start happening again at a higher volume than what we've been seeing.
James, any final comments or questions?
Yeah, I think the only other thing on the construction costs that we haven't touched on is I think I saw an article just around, like, people have stopped showing up for work at these construction sites because they're afraid that they're going to get deported if they don't have papers, or they don't want to get in the car to go to the grocery store. And so I think it's going to take a while for development starts to kick back up, not only from the equity side, but just from the cost side. Greg, what do you think in terms of, what do people like, John Griggs here in Dallas? He's been buying all this stuff below replacement cost, but he's been developing for the last 7, 8 years. How much of a gap do you need, or what do you need to develop at sort of per door to make it work right now? Like what does your cost need to be, you think, on just like garden, multi in Dallas?
No, and I don't have that number off the top of my head, but in terms of getting some product underway, you're correct that unless you're in some sort of special financing program, it's got to be garden suburban. You're not even close to making the numbers work on even mid-rise wrap, and you're miles away in terms of getting high-rise construction numbers to work at this point. So we will see construction activity begin to creep back into the marketplace, but it's going to be select neighborhoods and select product design.
I heard someone say this morning, James, yield on cost of 6.5 is kind of what the minimum is to get a start going. And it's probably, like Greg said, value engineered, generic garden commodity.
No taxes, everything.
Yeah, but like yield on cost 6.5, and you're building it in like a commodity value engineered way. You're not blowing it out and building the case study was on probably the highest profile building that's being built in Dallas at this meeting this morning at $2 million a unit, but they capitalized that in 2022, and it's 56 units and it's one of one in Dallas. And that was a case study we kind of got a lesson on, and it's a different ball game than what would be capitalized today. And it's real hard to capitalize that back then because there's just no comps to it. But it's just kind of about 6.5 yield on cost is what I was told this morning, and that's in Dallas. I'm sure that hurdle is higher in other markets as well.
I will share just a couple of blocks down the street from my house. A major merchant builder has started construction on a 2-story surface park building. I mean, I can't remember the last time I saw somebody actually just go 2 stories in this neighborhood.
And it's like a townhome deal or just like an individual, like
it's like the property in your
garden.
Background there.
Okay. Yeah. 1980s. Go back to the 1980s.
I mean, it's a 1980s. Yeah, it'll be updated. But it
was it more of that's the only way they could get it approved by the neighborhood. They didn't want a high rise.
I haven't actually talked to this developer on what in the world are they doing, and is there some sort of incentive on that site. But I was stunned to see the low density of this product get going.
Did you move to Oklahoma or something, Greg, or what?
I'm in funky East Plano.
Yeah. I can make sense in Oklahoma, maybe not in Dallas. I don't know. I don't have anything much more, Greg. We really appreciate you always coming on and being a frequent guest of ours, and your kind of view of the world and the insights you provide. If someone wants to learn a little bit more about Leaselock or get in contact with you, any resources you want to share about yourself or Leaselock?
Pretty easy to find. Just go to our website, leaselock.com, and you can track me down.
All right, Paul, anything else?
Nope, that's it. So we certainly do appreciate Greg Willett spending some time with us, and he's a guy we've spoken with and really used a lot of his great information over the, decade or 2 decades that I've known Greg. He is the center of the spider web. He is the big spider that of all the data that comes in. So follow him if you can for Greg Willett. So again, Michael Becker, certainly do appreciate the professor, James Zhang, and of course, Greg Willett. Thanks for spending some time with us. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.